Thanks, Rennie, for the introduction. Welcome, everyone, to our CB Insights research briefing, E-commerce 2018 Trends and Beyond. Again, I'm Nitin Reddy, and I'm an intelligence analyst here at CB Insights covering e-commerce, retail, as well as supply chain and logistics. Before we start, I just want to walk you through a quick overview of some of the topics we're going to be covering today. We'll start out looking at macro global trends in the e-commerce space, followed by a quick overview of investments into e-commerce startups around the world. We're then going to dive into some specific trends that we're seeing play out recently, which we've grouped into 4 categories: the merger of online and offline commerce, logistics, the targeting of consumers, and artificial intelligence in commerce. So without further ado, let's dive in. So taking a look on a macro scale, we're seeing a pattern of large e-commerce players fighting for market share. And in the US, online giant Amazon is dominating, which was demonstrated pretty clearly in its latest Cyber Monday transaction totals, which far outpaced any other retailer like Walmart, Target, or Best Buy. And in China, Alibaba has continued to raise the bar for its sales totals on Singles' Day, the largest e-commerce promotional day in the world. This highlights Alibaba's continued e-commerce dominance within the Chinese sphere. And as these online giants have grown in reach, many traditional retailers have felt the brunt, leading to the often discussed retail apocalypse. So here we have a timeline showing some of the most notable retail bankruptcies since 2015, and as you can see, many of the retailers on there are pretty well known. And taking a closer look, we can see that some of these retailers, like Radio Shack, actually filed for bankruptcy multiple times. Toys R Us was also notable for its recent bankruptcy, stemming both from online competition, but also from mounting debt and nervous suppliers that lost confidence in the store. And while traditional retailers have suffered, smaller e-commerce startups have also struggled to compete against the larger e-commerce players over the last few years. And now looking at investments into the e-commerce startup space, we're seeing a similar pattern of big player dominance taking hold. By that, I mean that although deals and funding to e-commerce startups rebounded in 2017, much of the dollar funding increase was due to billion-dollar-plus deals across only a few companies. Accordingly, when looking at deal share breakdown over the last 5 years, we see how the e-commerce startup space continues to mature over time, with seed and angel deals declining steadily each year since 2013. And from a geographic perspective, the US was home to only 41% of deals over the past 5 years, with Asian countries like China and India acting as the second largest hubs. And to that end, the 5 largest deals in the space in 2017 all took place in Asia and involved Asian corporate giants like Tencent, SoftBank, and Alibaba as investors, all of whom are battling against each other to win over consumers. So in response to some of these macro trends that we've discussed above, we see e-commerce companies, large and small, adopting new strategies and trends in order to stay competitive with consumers. The first trend we're going to discuss is the merging of online and offline commerce. So as traditional retailers increasingly go online, e-commerce players are also going brick and mortar. And this now begs the question, is pure play retail, online or offline, not sustainable going forward? An example of this convergence from the startup perspective is of how digitally native e-commerce startups have been opening physical stores for years as ways to better brand their products and build loyalty among consumers. However, more recently, we see e-commerce startups exploring less expensive ways and more creative ways of going brick and mortar beyond simply opening their own permanent store. A few examples include opening pop-up stores, which are typically just small retail spaces that are set up for a temporary amount of time. But they've also partnered with traditional retailers, and they're also finding new ways of physical distribution outside of a typical store and retail setting. So here are a few examples of startups opening pop-up stores. A home goods startup, Snow, for example, opened several pop-ups in New York to allow consumers to get a better feel for their products in person, since they felt that was important to the sales process. while clothing startup Everlane recently partnered with Nordstrom to open pop-up stores inside various Nordstrom stores. Online beauty retailer Glossier is an example of a company that used its pop-up space in London to host an event for celebrity beauty influencers. And this is an example of how pop-up space can be leveraged in different ways just besides acting as a retail space. Beyond Everlane's pop-up partnership with Nordstrom, we also see e-commerce startups partnering with retailers to directly sell their merchandise in-store. In the case on the slide, mattress startups in particular have taken advantage of this route into brick-and-mortar retail. Beyond pop-ups and partnerships, e-commerce startups are even seeking new routes into brick-and-mortar outside of the typical store or retail setting. Furniture startup Hem specifically works with the interior designers at the headquarters of other companies like Uber, Casper, and Pinterest to furnish their offices in the hopes that employees at those companies might learn about their furniture while at work. They've also co-hosted events with other startups like WeWork and Artsy, and I think what all of these moves demonstrate is how Hem is able to market their product to a particular demographic of consumers completely outside of any traditional retail experience. And as many retailers are looking to improve their brick-and-mortar presence, there are actually startups enabling them to do so. So Appear Here and Bulletin are two examples of these. Appear Here caters to companies looking to rent out physical pop-up space, and Bulletin sells digitally native brands in their own store. It's also worth mentioning that well-known mall operator Simon Malls, which is partnered with Appear Here, developed a program called The Edit, where startups would have a chance to open up shop inside Simon Mall locations for a few months in dedicated portions of the mall. So now we're going to take a look at a quick case study of how the two largest e-commerce giants, Amazon and Alibaba, are also combining online and offline commerce. Both companies have taken a multi-pronged approach to entering the brick-and-mortar space, and this has included investing in startups, buying and partnering with traditional retailers, as well as opening up their own physical stores. And here we can see a smattering of Amazon and Alibaba's brick-and-mortar initiatives. And from the perspective of investments and acquisitions, both giants have made significant inroads into physical retail, and particularly into grocery. Amazon acquired Whole Foods in mid-2017 for $13 billion, over $13 billion. And while not featured on the slide, Alibaba also made a significant investment into Sun Art Retail, which is a supermart operator in China. Amazon's acquisition of Whole Foods in particular has created a big stir in the American grocery industry, with many retailers worried about their tech and delivery capabilities. Both e-commerce companies have also entered into many physical retail-related partnerships, with Amazon partnering with both Calvin Klein and Kohl's. In terms of scale, though, Alibaba has really taken brick-and-mortar partnerships to the next level. The company actually partnered with over 500,000 mom-and-pop stores around China to have them act as fulfillment centers on Singles' Day 2017. They've also partnered with Starbucks to implement augmented reality technology in store, and with Ford to even create a car vending machine. And lastly, of course, Amazon recently just opened its first ever cashierless Amazon Go store a few weeks back, and Alibaba, on the other hand, has already opened dozens of tech-enabled grocery stores, which they've named Hema. So referencing back to an earlier slide, we witnessed massive dollar investment in China and the rest of Asia. Another factor that has made the region stand out in e-commerce is the rise of mobile payment adoption. Mobile payments being payments that are made through mobile devices instead of through typical cash, credit card, or check. In China specifically, mobile payment technology has taken off at an astronomically higher pace than in the US, and this has allowed e-commerce and retail to really develop at a faster pace than in the West. With Chinese consumers much more accustomed to making payments through their phones. It's also meant that Chinese consumers in general are also more comfortable with incorporating retail and mobile payments into the brick and mortar experience. And while Alibaba's push into brick and mortar has been more aggressive than Amazon, Alibaba does face immediate and direct competition from players like Tencent and JD.com that are also looking to open up their own automated stores and are partnering with grocery retailers like Carrefour. So moving on to our next trend now, we're going to discuss how logistics startups are enabling e-commerce players to remain competitive. Well, Instacart has been around for years and actually just raised $200 million yesterday. Retailers have been upping their logistics and delivery game in the wake of Amazon's Whole Foods acquisition, which we just mentioned earlier. The most notable examples of this have been Albertsons' acquisition of meal kit delivery startup Plated, Walmart's acquisition of last mile delivery startup Parcel, and Target's acquisition of grocery startup Shipt, all of which took place at the tail end of 2017. Just last week, Amazon announced it would launch a 2-hour grocery delivery service from Whole Foods to Amazon Prime members in select cities, and this definitely adds to a growing worry that many of these American grocery retailers already feel in the face of Amazon's competition. And also, while not entirely related, there are even reports that Amazon is planning to launch its own delivery service that would directly compete against FedEx and UPS. We've also seen last mile delivery startups begin to partner with companies outside of retail, but to work on initiatives that could still directly affect e-commerce. For example, Deliv partnered with smart lock startup August to provide the option of in-home delivery to customers. Customers with the August Home smart locks would essentially select an option for in-home delivery, whereby a delivery driver through Deliv would be given a temporary one-time password to gain access and deliver goods inside the home. And additionally, Postmates partnered with Ford to work on autonomous vehicle delivery, while DoorDash has partnered with robotics startup Marvel in August to experiment with delivery robots. Beyond Marvel, other startups that have also gained traction in the autonomous delivery space include Nuro, which just came out of stealth mode and raised a whopping $92 million from investors, including Greylock Partners. Nuro is specifically going to focus on delivering goods in autonomous cart-sized vehicles. Similarly, startup Udelv has developed autonomous delivery trucks that it already has begun testing on the road in the San Francisco Bay Area. Darkstore is a startup that enables last mile delivery without actually delivering anything itself. It works by setting up micro-fulfillment centers across the city, taking advantage of excess space in local malls, warehouses, or bodegas. Online retailers can go through Darkstore to place their goods in these fulfillment centers, which are then picked up by last mile delivery partners. Darkstore works with a number of retailers, including Tuft & Needle, Master & Dynamic, and Wildfang. And on the corporate side, Amazon is also thinking up fulfillment center-focused solutions to last mile delivery. This particular patent multi-level fulfillment center for unmanned aerial vehicles, which we've also dubbed Beehive, would act as a floating warehouse that would essentially serve as inbound and outbound last mile delivery drones. And you can see some basically futuristic version of how we might handle last mile delivery in the future. Overall, logistics visibility is something that remains highly important to online retailers looking to service their customers efficiently. And a number of startups have received funding in the latter half of 2017 that specifically provide logistics and delivery management software that's geared towards retailers and brands. These startups often aim to serve online retailers that don't have the in-house logistics capabilities of a company like Amazon, and thus it enables them to compete more fairly. And some startups even actually just focus on returns, with some studies estimating that the return rates are above 30% in the e-commerce space. It really, returns in of themselves bear a huge cost and burden on online retailers. Happy Returns helps online retailers offer in-person returns while saving the retailers money and time. When a customer returns an item from a retailer that uses Happy Returns, they just go to one of Happy Returns' return bar locations, and where it's then essentially shipped to Happy Returns warehouse, where all of that particular retailer's returns are aggregated and shipped back to that retailer in bulk, which saves shipment cost per item. So now we're going to take a quick look at startup Flexport and the technology transformation taking place in the freight forwarding and international shipping space, and specifically why it matters to e-commerce. So what is freight forwarding? That's a big question that many people ask. Freight forwarding is the logistical management of freight as it moves across the global supply chain. And what that actually means is when large retailers or brands order materials from China, for example, a freight forwarder like DHL will coordinate the movement of goods from the manufacturer in China to a warehouse, to a port, then to a ship, to another port, and so on until it reaches its final destination in the US. The freight forwarding industry has been traditionally very low tech, and there's been typically very low visibility into the overall process for those looking to track their goods as they move across the world. And so this is where Flexport comes in. Flexport is a San Francisco-based startup that incorporates software and data to provide real-time visibility to clients who are often e-commerce startups that are looking to ship freight across the globe. Flexport uses data to try to cut down on inefficiencies in their customers' freight shipping routes and supply chains, thereby saving their clients money. Additionally, if something does not go as planned, Flexport promises better visibility into where freight is in the world and when it might arrive, instead of having no clue where anything is. So why does this matter to online retailers? First of all, many of the clients are already small but well-known e-commerce startups like Warby Parker and Casper. Secondly, Flexport is aiming to offer speedier trade financing to its customers. Trade financing, which is the upfront cost needed to be paid by companies looking to ship freight, is often very prohibitive. When small to medium-sized businesses apply to traditional banks for trade financing, they're often rejected at a much higher rate than larger multinational corporations. This often keeps them from participating in international trade. So if Flexport is able to provide speedier trade financing, it may set a trend for enabling smaller e-commerce businesses to participate in the global trade ecosystem. Thirdly, Flexport has positioned itself as an alternative to using Amazon, which has also recently entered the freight forwarding space. Flexport's argument is that Warby Parker, for example, might not want to provide all of its manufacturing and supply chain information to Amazon, who, although may not directly compete with them now, could become a competitor in the future. So Flexport touts itself as a safe alternative to this dilemma. So now moving on, as e-commerce becomes a harder model in which to compete, we're seeing that it's really no longer enough just to set up an online store. Consumers must be deliberately and specifically targeted. Accordingly, we've seen e-commerce players employ different strategies to customize and personalize their online customer experience. Starting off, we've seen a rise in the media discussion of private labels, and while they've become a popular tool for traditional retailers to save on costs and increase their margins in a highly competitive environment, e-commerce startups are also taking advantage of this strategy too in order to better target consumers. Wholesale e-commerce startup Boxed has produced its own private label line, Prince & Spring, which is now estimated to make up approximately 20% of the company's sales. Box is also a hot acquisition contender for many other companies, including Amazon and Kroger, for which the startup reportedly recently rejected an acquisition offer. Other startups have also taken advantage of private labels in other ways. Brandless and Public Goods have used private labels as a way to provide a limited selection of deliberately chosen items in their online stores. While big retailers that have private labels also tend to sell a myriad of other brands, these startups alleviate the burden of choosing from the customer and really of deciding among which brands to pick and what brands to buy. Although Thrive Market does sell third-party brands in addition to its private labels, it's also used the idea of curation, in their case of exclusively natural-only products, as a way to attract a particular base of consumers. And while curation has been one tactic used to target consumers, personalization has also been another. And in reality, they really aren't so different from each other. While curation-focused startups limit the choice of the items they sell, personalization-focused startups also alleviate customers of choice by making a single product that is unique to them. Stitch Fix, probably one of the most famous personalization-focused startups, went IPO at the end of 2017. And while the company opened at a price initially below expectations, it's now trading above its opening price. And Stitch Fix essentially creates personalized apparel for clients using a combination of AI and internal stylists. And in the last year, e-commerce personalization has also spanned a variety of products ranging from apparel in the case of Le Chemiseur and Stitch Fix to baby food in the case of Little Spoon to shampoo in the case of Function of Beauty. And all of these startups have raised funding in the last year. And it's also interesting to note that across these startups, they all encompass different types of personalization. So while home goods startup Grove personalizes boxes of different products based on a customer's preference, Le Chemiseur creates custom clothes based on fitting size. Function Beauty actually creates an entirely unique hair product that is formulated just based off an online customer quiz. Artificial intelligence is also being used to improve various parts of the e-commerce ecosystem, and particularly is being incorporated into some of the themes and trends that we've already discussed in this presentation. Here we have a quick map of some of the startups using AI in commerce, and many of them have traditionally focused on natural language processing and visual search, among other categories. However, as I just mentioned, startups are also incorporating AI to aid in themes that we've already discussed, including the integration of online and offline commerce, supply chain and logistics, as well as personalization and customization. France-based Timo offers an AI-powered marketing platform that services retailers. The company partners with mobile apps to track the physical movement of consumers into certain shops. Using machine learning, it then identifies potentially valuable customers based on their physical shopping traffic pattern and sends them mobile ads on behalf of their retail clients. And I think this is an example of true integration between what's going on in the physical world and online. Companies are also improving supply chain and logistics for retailers using AI. Aquafy developed a 3D scanning tool that can efficiently inspect packaged goods during the logistics and e-commerce fulfillment process, while Vecchia offers an AI-powered supply chain logistics management software for retailers. Both have been backed by well-known investors, including Benchmark for Aquafy and BPI France for Vecchia. And Body Labs, a startup recently acquired by Amazon, used AI-powered technology to analyze human body shape and motion. And while the company certainly has use cases in other fields, such as gaming, it no doubt could provide next-gen personalization technology in the area of e-commerce styling and fitting. And as we discussed earlier, return rates are much higher in online retail, so any technology that could provide a better understanding of a product's fit before purchase would surely be beneficial. So, wanting to conclude this presentation on a positive note, I just want to highlight that while e-commerce in and of itself is constantly evolving and currently dominated by a lot of larger players, as we discussed, it still really acts as a conduit for smaller players and those from developing countries to participate in the global economy. And whether it's through Alibaba's partnership with over 500,000 mom-and-pop shops or through Flexport's speedier trade financing that can benefit smaller to medium-sized businesses, we may continue to see opportunities for small player participation in the greater e-commerce space going forward. All right, so now we're going to take a couple questions from those tuning in. I have a lot of questions coming in now, and so I'm just going to select a few and answer them. So let's see what we have. Great, so here's one. What does Amazon's recent announcement about its entrance into the delivery space to compete against FedEx and UPS mean for the greater logistics space? This is an interesting one because this isn't the first move by Amazon, obviously, into third-party logistics in a sense. Like I mentioned in the presentation, Amazon has also entered into freight forwarding. And so obviously they're generally looking to up their overall logistics capabilities. In this case, in terms of competing against FedEx and UPS, I think they clearly do represent some sort of threat, although it's really unclear at the moment what Amazon's actual logistic capabilities and capacity are in terms of providing third-party delivery. That will be interesting to see going forward, just because FedEx and UPS have decades of experience in that space. Not to say that there couldn't be further tension down the road. That's sort of to be decided how that develops going forward. And it will be interesting to see how that plays in parallel to how Amazon does in freight forwarding as well, against some of the larger freight forwarders like DHL. Okay, let's see what other questions we have here. Okay, here's another one. Instacart just raised a huge round of funding, given that it's part of the wider, more struggling food delivery space. Why is it doing well? So this is an interesting point here, because the overall food delivery space, especially when you're talking about meal delivery, meal kits, has clearly struggled over the last year, to raise funding, but even once going public in the case of Blue Apron, have still struggled to maintain margins, compete against other players in the space, and also maintain a solid customer base, because a lot of people tend to only order things offhand and don't consistently use their services. I think what Instacart has found is that, first of all, it's a grocery delivery, which really is a bit different and is doing better than overall food delivery and on-demand. B, given all the announcements going on, one that I mentioned in the presentation regarding Amazon's new 2-hour Prime delivery grocery service from Whole Foods, other traditional grocery retailers, and this was sort of mentioned in the presentation as well, are very concerned about their logistics and online digital commerce capabilities. So what Instacart provides them is a ability to compete, servicing retailers that might not have the in-house capabilities of an Amazon. And so hence, you see traditional retailers already beginning to partner with Instacart, like Aldi, which has really been exclusively an offline business, recently partnering with Instacart to test out grocery delivery. I think we're going to continue to see more partnerships like this going forward, and potentially more acquisitions going forward. And here's another question that I'm seeing right here. How will personalization affect offline and brick and mortar retail? So we touched on personalization, of course, in the presentation, and it tended to focus a little bit more on how it works in the e-commerce realm in terms of ordering goods, or entering a quiz online, or your stats and measurements online to get custom fit clothing or custom shampoo. I think in the brick and mortar sphere, it takes on a slightly different appearance. What you do see and have are companies like Alibaba and Amazon, in the midst of all their offline initiatives, have also developed a lot of internal technology that they're testing out in a lot of their brick and mortar locations and stores. Alibaba in particular has been really active in this area, and has installed fitting room technology called Magic Mirror, where you can essentially try on different outfits in sort of like a digital mirror. Amazon has sort of made a similar patent to that. Additionally, I think from a more analytics marketing perspective, one company that I just touched on in the presentation as well, Timo, which sort of combines looking at offline shopping patterns with digital marketing. I think that's another area where we're going to see personalization enter into physical retail, where they're truly combined. So in a sense, it's not necessarily the in-store experience that you're getting, but because of your physical activity in certain stores, you're receiving personalized ads. I think that's another way in which personalization can affect the offline world, or vice versa. So with that, I'm going to conclude the presentation. Thank you, everyone, for listening, and feel free, if you have any questions, to connect with me on Twitter at Natan_Reddy, or send me an email at nreddy@cbinsights.com. Have a great day.